Better System Trader, episode 29.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Thanks for joining us on the Better System Trader podcast. This is episode 29, and I'm your host, Andrew Swanscott. Our guest today is Clement, a certified financial technician, full-time independent trader, quantitative trading systems designer, and private investment consultant. He is also a counsellor with the Australian Technical Analysts Association and contributes to the technical analysis articles for Fairfax Press. In this week's episode, we discuss solutions to a number of problems traders face, including how to manage risk, not just through using stops, but the impact stops can actually have on risk, and alternatives to managing risk which can increase performance. Alan also shares tips on measuring system health and adjusting position size dynamically according to the current health of the system. We also talk about rotational trading systems, anticipating trading signals, designing your own backtesting metrics, and for those just starting out, 5 factors to consider when choosing a strategy to suit your personality. Alan shares loads of advice with us this week, so let's get to it. I hope you enjoy the chat with Clement. Thanks for joining us today, Alan. Now, to get started, can you give us a little bit of background on yourself, how you got started in trading and what you do now?
Yeah, absolutely. And I'd like just to say thanks for the invite, Andrew. It's great to be with you on your show. My professional background was actually in software development, but I worked very much within the financial industry, and I worked both on the buy and the sell side. So I worked for a Tier 1 investment bank for a long time. I also worked in the investment management sphere. And while my role wasn't specifically developing trading systems at that point, I did work very closely with the guys in the front office. So I got very much to know how they operate, to find out about the various products that they traded in, and also learn a bit about how markets work as well. So when I left the corporate world in the early 2000s, I decided to have a go at trading my own account. And so I did what most people do when they start. I read lots of books on trading and technical analysis. I went to a few seminars, and I started trading in small size, trading mostly indices at that time, but really trading in a very discretionary way. And for a long time, I wasn't really comfortable with that style of trading. And a lot of people were saying, "Oh, well, trading is an art, not a science," and I was never really comfortable with that. And for the main reason that you have no expectations of what you can achieve. When you get into a trade, you don't know what your drawdown is going to be, what your probability of success is going to be, and all those kinds of things. So my results were, I managed to achieve a level of success, but my results weren't great. And it wasn't until probably a few years after that I started that somebody introduced me to a systematic approach and quantitative trading, and at that point there was lots of lights came on in my head because I had a software background, I had lots of knowledge of how markets worked, and it seemed to me that to put those two together and really approach it as a science, as a statistical exercise rather than an art was a much better way to do things. And because it gave me expectations, I could design a system that was going to fit my objectives, it was going to fit with my own personality and lifestyle, and then it would give me some expectations of what that system was going to achieve, both in terms of win rate, expectancy, drawdown, risk, return, all those kinds of things. And then I would know trading forward when I put a trade on what my probability of success was, and then I was comfortable with that. It also gave me the ability to know when the system was outperforming or underperforming as well. And it was really at that point that I started to get a consistently good level of success, and from there has allowed me to continue as a full-time independent trader. Nowadays, my whole world is really taken up with testing and designing trading systems. That's really the sort of the passion I have. Although the main part of my business is still trading my own account, but on the side, I also work with private traders who are looking to get into a more systematic approach. I've also worked with a number of institutional traders and hedge funds as well, helping them design systems that are going to meet those objectives. So yeah, that's how I got to where I am now.
Okay, great. So I understand that you cover a couple of different styles of trading. So what can you tell us about that?
Yeah, well, to me, most trading systems fall into two categories. They're either trend following, in other words, they're trading momentum, or they're mean reverting. So, in other words, they're reversal systems or swing, sometimes called swing trading. You could say there's a third style, which is seasonality, but to me, seasonality usually falls under one of those two categories. You're either using seasonality to trend follow or to find reversals in the market. So what I aim to do in my world is to trade a selection of those styles on multiple different markets. So I have trend following approaches, I have mean reversion approaches, and the idea being that the overperformance and underperformance of those various systems will tend to smooth out my own equity over time. So as a trending system starts to underperform when there's a bear market, for example, then if the mean reversion systems at that point should fire up and start making more money because the volatility is higher. So it's having systems, I guess, that will navigate their way through many different market types, as well as having them on multiple different markets. Yeah.
Yeah, okay. So if we just talk about trend following for a minute, there's a number of ways to measure momentum. What particular ways have you found effective?
Yeah. Okay. Well, one particular method that I use for trend following is using a rotational approach, and the way that works is it uses, like you say, it uses some sort of measure of momentum to rank a basket of instruments, whether that's a basket of stocks in an index or a set of commodities or a set of currencies, whatever it happens to be, and you use the momentum tool, the momentum indicator, effectively to rank the stocks, and then you aim to just hold a small basket or small portfolio, if you like, of the highest performing stocks. So, let's just have a think about what momentum is for a minute. Momentum is really how fast and how strong a particular instrument is moving either up or down. If we're thinking about a long system, we're looking for stocks that are moving up the strongest and with the highest velocity, because those are the ones that will tend to continue to move higher, at least in the short term, which is all we could really say. And there's been numerous academic studies that have proven momentum to be an inefficiency in the market that we can trade. Yeah. So how do we measure that? Well, there's multiple different ways. If we think of some of the popular indicator tools that are out there already, we have things like rate of change, which is basically just the percentage change in price over a given period. We have things like Wells Wilder's ADX. He very famously came up with that. That is a momentum measuring tool. You can also just use something as simple as a moving average. Measure the momentum of the moving average. How fast is the moving average moving up or down? And there's other ones as well. There's trend strength index. There's even the MACD. A lot of people think of the MACD as being a short-term oscillator, but it's actually a momentum type of indicator. And if you look at that over a longer period of time, if you're trying to get a trend following system that's going to hold for a period of days or weeks, then that can actually work quite well as a tool to give you an indication of what's the best performings in the market.
Okay, and I guess the idea behind rotational systems, as you mentioned, is to take the top performers over a period of time. But what happens when the trend changes and everything starts going down?
Yeah. Okay. So when with a rotational system, you have, I think you have to build. It's not just the momentum scoring tool that's going to give you that's going to make the success of the system. That's just one element to it, and I think you'll need other filters in there as well. Things for like filtering for volatility, for liquidity, and so on. But in terms of an exit, then there's basically a couple of things you can take into account. The main exit for a rotational system, of course, is the rotation itself. So as a stock falls out of your top 5 or 10 or whatever size your portfolio is, then you sell that stock and then you buy one that's popping up into that set, and that will basically smooth out your returns, because you're basically selling one that's falling in momentum and you're buying one that's increasing momentum, and the crossover of those two will give you a smoother outcome than say a traditional stop loss. So one thing you can do to manage risk in those systems is you can have a minimum value placed on the scoring indicator. So if let's take ADX for an example, because that's a popular one that many people will have heard of. Generally, the consensus is that if the ADX is above a value of 25, then the stock is in a strong trend. So what we could say is, well, we could have a minimum on the ADX of say 20, and if the stock that falls down through that 20 level, then you're going to sell it regardless. And what will happen in a bear market is, as a lot of stocks will start to fall as the market falls, then they will increasingly fall down below that level, and your list of candidates will get increasingly shorter until you hold, say 5, 4, 3, 2, 1, 0. Another approach or an additional approach you can take is to use what's called a market regime filter. So some method of knowing what the wider market is doing. Now, you can do that on an index, or you can use market breadth or one of those types of indicators, and that will give you an assessment of whether the market is bullish or bearish. And so if the market is generally bullish, then you take positions and you travel along as you would. If the market turns bearish, then that's the point there you would either go flat or you would use some other risk management tool to lower your exposure at that point.
Yeah. Okay. And if we talk about timeframes for a minute, how often do you actually review your positions to see which ones are ranking the highest?
Yeah, well, that's a very interesting question, actually, because I've done a lot of testing on this, and what I've found is that about a week tends to be the sweet spot for these types of systems. If you go to daily rotations, you're going to increase turnover, obviously, because the rankings will be noisier and they'll be going up and down. So you'll tend to be buying and selling a lot more, and obviously that adds costs to the system and so on. If you go further out, if you go out to 2 weeks, 3 weeks, even a month, then what you'll find is that you will start to increase risk in the system, because especially if there's a large market event, or if there's a bear market cut ensues, then that can quite quickly draw a lot of the stocks down before you get to that next rotation. So having tested these types of systems across everything from daily all the way out to monthly and beyond, rotating them on a weekly basis does tend to be a sweet spot for these systems.
And it's very good if you want to be a little bit lazy as well, I guess, isn't it?
Well, again, that's one of the reasons why I like these systems, because they are very low maintenance. You only have to look at it once a week, and then sometimes there's nothing to do. If your top set of holdings the rankings have remained the same, then there's nothing to do. There's no buys and no sells. So they're very very easy to trade, very low maintenance. Yeah.
Okay, a little bit more on risk management. So you've mentioned two approaches there for risk management. You can you've got either a market regime or a minimum level for your ranking. But what about a stop? Can you use a stop in a rotational type of strategy?
Yes, you can. Yeah, absolutely. You can use a stop. There is, but to me, the stops themselves are problematic. And let's just have a think about what a stop is. If we're talking about a stop loss type of order or exit in a system, basically what we're doing is we're placing the exit order below. Let's just think about a long trade for simplicity. We're placing it below where the market price is, and so in order for the exit to be executed, the market has to fall from where it is down to where that stop loss level is, and that difference between the high point and where the stop loss is effectively drawdown. So when you use stops in a system, they will tend to introduce drawdown into the system. In other words, they're introducing risk into the system, and by the same token, they will also tend to reduce return for the same reason, because you could have got out at a much higher point, instead you got out at that lower level. So I think stops themselves are problematic for that reason. Now, some people will say, well, what if you put it further away? What if you just use it as a so-called disaster stop, and you have you have it like say 6 or 8 ATR away, miles away, where it might not get hit. Well, the trouble with that is if you do testing over any sort of lengthy period, what you'll find is it almost always will occasionally get hit, and then it will introduce a large drawdown at that point. So I happen to think that there's much better ways to and I'm not saying to anyone listening, run off and get rid of all your stop loss orders. You absolutely have to have an exit strategy. You have to have an exit strategy of some kind. But what I'm proposing is that there are much better technical exits than there are than just using a stop loss. I mean, as someone said on this very illustrious podcast once before, stop losses are insurance, and insurance costs money. And so that's what you have to keep in the back of your mind, I think, that it's a way for us to have some sort of insurance, but we're paying a cost for that. And to me, risk should be a function of the entire system, not of each trade. So we need to think about risk as a function of the system, and we need to use position sizing to manage it rather than using a stop loss on each particular trade.
So I know a lot of people will use the stop loss value to determine the position size, but how would you do that without a stop?
Well, once again, you have to do it as a function of the system. So when you're designing and developing your system, you have to look at what the overall metrics of the system are, and to me, the best way of establishing position size is two things really need to be taken into account. How many holdings the position is going to have, what's its maximum number of holdings, and two, what is the risk in the system, and the measurement of risk for most people is drawdown itself. So we can use those two to manage the risk per trade, and if we do that in a sensible way, which we can discuss in more detail, then that will be a way for us to manage risk on the overall portfolio and not be concerned with what each individual trade does.
Okay, we might come back to that. But firstly, you mentioned that perhaps there are other exit strategies that can be used rather than just a fixed stop level. Can you expand a little bit on that?
Yeah, sure. So again, trying to get away from that idea of putting a stop below the price action. What about if we had something that was more dynamic? So markets don't go down in a straight line. They don't. A stock doesn't go from $100 to zero in one day. What will tend to happen is that it will go down, it will pull back up, it will go down a bit more, and it pull back up. So one technique that I like to use is what I call dynamic profit target. So using a profit target, but not just saying, okay, if the stock goes up by 10%, then I'll sell. Use something that's dynamic so that it moves with the price action. So a simple example would be using something like a Bollinger Band. So the Bollinger Band moves with the price action. So if the stock goes up and it outperforms over the short term, it's going to hit that top band, for example, and then that could be one way of getting out. And by the same token, if you get into a trade and it takes off to the downsides instead of the upside, then eventually it will pop back up. And when it does, it will get you out closer to your entry point than using a traditional stop loss, thereby reducing the risk in the system and also saving a little bit more of the return. That's one method. Another one, which is kind of which we touched on in the rotational systems, is using what you might call a change in momentum. So again, when a stock goes up, it doesn't tend to go up and then straight down. What it will do is it will go up and then it will tend to consolidate or go through some sort of distribution phase, and that will then signal a loss of momentum. And so if you use that, you're going to get out probably much closer to either the middle of the range of prices or even the top of the range of the prices, rather than getting out at a capitulation point. So that works very well, especially in things like rotational systems. You can also use some sort of reversion system. So if we think about overbought, oversold, some sort of oscillator. Once again, those are, there's plenty of them around, but it's the same idea as the dynamic profit stop, whereby it moves with the price. So you're looking to get out at the top of the range of prices, not the bottom of the range of prices, even if the market's falling. That would be still the aim. And the final one I would just say is managing your risk by position size once again. So if you have if you take a portfolio approach, so rather than just trading one index or one currency or one whatever it is, take a more portfolio approach to the system. So allow the system to hold, say, 10 holdings instead, and then each one of those will only be then 10% of the account. So if you have if you're thinking about stocks, if you have a stock system that holds 10 stocks, if one of those stocks takes a 50% hit, then that's only really 10% of the account. So that's only going to be a 5% hit on the account, which most people can withstand. So if you manage it through position size, you can get away from once again from using the traditional stop loss methodology.
Okay. Lots of interesting ideas there. Thanks, Alan. Let's move on to backtesting a little bit. Actually, firstly, you mentioned before that you should look at risk at not so much an individual trade kind of level, but a systematic level. How do you measure that accurately?
Yeah, okay. Well, there's with a couple of things to say up front. The first thing to say is drawdown is not a single number. When we run a backtest, we get a single number for the maximum drawdown that's happened over that period of time. Even out of sample, you're going to get a single number for maximum drawdown. But that's only because the trades fell in that particular order. It's because the losses and the wins all added up to produce that single number. Had the trades fallen in a different order, then that number could be different. In fact, it could be very different. If we got all the winners together and all the losers together, it would be a bigger number. If they were more evenly distributed, it might be a much smaller number. So drawdown is not a single number; it's a distribution. So it could be a range of things. It could be, say a system has a distribution of drawdown expectation that ranges from 5% to 25%, say, and it could the outcome going forward through time could be any one of them. We have no way of knowing at this point. So one methodology you can apply is to use Monte Carlo to test for what the probability of a drawdown of a particular size is over a certain period. So say for example we have a 2-year out of sample test. We can take that, run it through Monte Carlo, and we'll get a distribution of drawdown numbers, and then we can look up at the 95th percentile, and then that will give us an idea of what drawdown. So if you want to express it this way, we might have a 5% probability of a drawdown larger than the amount that's at the 95th percentile over the next 2 years. And so if you use that number, say it's 30%, 30 for example, and our own risk appetite is, say, only 15%, then what you can do is you just dial down the position size by half. So instead of trading at full size, you trade at what's called half fraction. In other words, you keep 50% of your funds away from the system, quarantined, if you like, from risk, and then you only apply half the position size to each system, to each trade. Conversely, of course, if you do the analysis and it turns out that the drawdown expectation is only 10%, and our risk appetite is where we're happy to take a drawdown up and say at 20%, then that allows you to leverage up. So you can take position sizes effectively twice as big as what the initial system was taking. So you would use leverage to double your size, and then your risk, your drawdown expectation is also doubled, but your returns are also doubled as well. So using the Monte Carlo tool to give you that distribution is the way to do it. And you can actually take it one step further now, which is to make it dynamic. Now this is probably a little bit more advanced, but what you can do is you can use a moving window of trades, especially if you're live trading, and then you can run them through the Monte Carlo engine when you get each new completed trade coming on, and you drop the last one off the window, and then you can use that to generate what your position size is going to be for the next trade. And the advantage of using that is if you have a system that starts going into drawdown, then that's going to increasingly reduce your position size with each new losing trade that you get until you're trading at zero fraction, basically. And that has the effect of limiting the amount of drawdown that your system will take. And then on the flip side of that, when the when you get a string of winners, then the position size will inflate, and that means that you'll be able to take advantage of that good run in the system. So that's something else you can do. That takes a little bit more work and a little bit more coding to be able to do that. But at least if you just do the basics and establish your position size based on the risk in the system using a distribution of drawdowns, then you're going to have a much more chance of being able to trade through those bad times.
Yeah, that's interesting approach actually to use a rolling window, because I guess it can often be hard to determine if a system is healthy or not. Why do you think that is?
Well, the first reason is because most people don't have any idea what their system's expectation is to begin with. So it's very hard to understand. If you've just bought, got a set of rules off the internet, or if you've just read something out of a book and just tried to apply it. So it's the first thing you have to do is to use a systematic approach to establish what the realistic expectations are for the system. So that's going to give you what I would call the long-term metrics for the system. So what is the drawdown expectation? What is the win rate expectation? The holding period, the expectancy, risk return, all those things. You'll have some sort of expectations of what the system can produce over the long term. Now, as we know, that not all systems work through all market conditions. It just doesn't work like that. Markets go up, they go down, they go sideways, they go from high volatility to low volatility, and there's no one system that's going to be able to handle all those various types of markets. So we have to expect that there's going to be outperformance and underperformance in the systems, and the results of any system will tend to wax or wane. Even if you've got the logic in it to turn off when it's not the optimal conditions, then that's going to create a flat spot in the equity line. But even if you don't have that, you can have some way of establishing whether the system is performing as expected, or whether it's underperforming, or even whether it's sick or broken. When we have a system that goes into drawdown, we never really know if that's just going to be a drawdown that's within the realms of expectation, or whether this is the start of the end for the system altogether. So, the way to think about it is the model of the system is fixed. We have a fixed set of rules generally, and a reasonably fixed set of parameters, and the market data is dynamic, so it's a moving target, and so the model can either be in sync with the market data, or it can drift out of sync. And when it drifts out of sync, that means that it's going to underperform. Generally, the win rate will drop. Generally, the drawdown will increase. Those all the things that we don't like about the system. So what you can do is you can look at basically the short run metrics against the long run metrics. So you've got your long in sample out of sample backtest that you've established before you started trading the system, and then you can look at what has it done in the last. I mean, this very much depends on how frequently it trades, but say what has it done in the last 10, 15, 20, even 30 trades or whatever, and you can use that once again, that rolling window to determine what the short run metrics are. So we take an example, say a mean reversion system, which has a fairly high win rate of, say, 75%. That means that we would expect that we should get 7 or 8 winners out of each 10 trades. Now, that very rarely happens that it sits on that sweet spot for very long. What tends to happen is it will either be above that, and you can get periods of 9, 10 winners out of 10 for quite a while, and conversely, it can drop way down, 6, 5, 4, 3, 2, 1 winner in the last 10. So what you can do is you can establish some sort of limitation whereby you will stop taking new entries at a particular point, and this is what I call the system health. So you can look at things, and I've come up with my own algorithm, if you like, which looks at both win rate, open drawdown, closed drawdown. But you can look at any metrics you like to determine that. You could look at the drop off in the return. You could look at whether it's drifting away from its standard holding period, those kinds of things. But however you measure it, once you establish a set of minimums for that system health, and once it drops below that level, then you basically stop taking new entries. You allow the system to keep taking trades, if you like, in whichever tool you're using to log the trades or to generate the signals, and then you basically monitor the system while you're not taking any new entries until hopefully it comes back into sync with the market. And once it jumps up against above those minimums again, then you start taking entries once again. Of course, if it's completely broken, it's never going to get to that point again. But what you've done is you've established a minimum that's going to basically it's going to stop your drawdown, or it's going to limit the amount of drawdown that you take in that system. So it's going to protect you from trading that system into the ground until you've blown your account up.
That's really interesting. So if you use this approach of comparing the short-term run with the long-term, how do you actually establish a level that you're happy with? Is there a way to quantify that, or is that just a subjective matter?
Well, to me, it all flows from your own objectives. What is it that you're trying to achieve with this system? Your expectation will be for it to generate a certain amount of return. You will be comfortable with a certain win rate and drawdown as well. So, you could say that if you've established what the worst drawdown is that the system's had over whatever test period you've used, then you can say, well, if it reaches a certain percentage of that maximum historical drawdown, then that's the point that I'm going to stop taking new trades. So that could be, say, 70% of the historic maximum drawdown. Now the chances are it will move through that, because you'll probably have open positions that will take it lower than that. But if you don't add any new entries to that, then you're going to avoid taking additional drawdown. So if you think of a trending system that hits a bear market, for example, while it's got some positions open, those are the ones that are going to get hit. But if you get signaled to take new positions, which may, in all probability, turn out to be losing positions, then if you can avoid taking them, that's going to stem that tide of drawdown. Similarly for win rate, again, if you have a system that wins 7 or 8 times out of 10, then you might think, well, if it drops down below, say, 5 in the last 10 or even 4 in the last 10, then to me there's something happening that the system can't cope with in the market. So I'm just going to take it offline, and I'm just going to sit and wait for that win rate to get back up. And these types of things work much better on systems that trade more often. So they're very good for things like mean reversion systems. For trending systems that are lower frequency, they tend not to work quite well, because you can end up sitting out of the market for a period as the thing is starting to recover. And as we know, sometimes the start of new trends out the bottom of bear markets tend to be some of the best times to be in this system. So it's very much horses for courses, and you have to sort of adjust the metrics that you're using. But in general, it will give you a level of safety that's out with the standard risk management tools.
Okay. Well, continuing on with the discussion on metrics, obviously when we're backtesting, everyone has their favorite metrics or optimization targets to compare system performance. What do you use?
Well, I think before I say what I use, I think that this really all starts once again with your own objectives and your own limitations, and you should really establish that up front before you even go looking for any system, or before you even start testing any system. You have to establish what it is your own objectives, and your own objectives will be quantified in terms of risk, reward, holding period, expectancy, win rate. And so all those have to be established up front. And then what we're trying to do is we're trying to find a system that's going to fit with not only with those objectives, but also fit with our own personality and lifestyle as well. So what you can do is you can actually combine some of them. If you say, oh, well, I want a system that that has a 20% return, and I'm happy to take a 25% drawdown to get there, or whatever, then you can establish a metric that combines those two. And basically, what we're trying to do is we're trying to you're generally going to look at more than one system, or you're generally going to look at multiple candidates of a particular system, say with different parameter sets. And so what we're looking for is the one that does the best. So in other words, this is a test of goodness of the system. And in my experience, the best ones tend to be metrics that combine both risk and reward. So, for example, Sharpe ratio is a very popular one. I happen to think Sharpe ratio is a little bit problematic, but it's quite popular in the professional side of the industry. But even if you just use the annual return divided by the maximum historical drawdown, that in itself will give you perfectly good results. And what we're all looking for, I guess, is the smoothness and the steepness of the equity curve. So what the optimization objective gives you is you're looking for the smoothest and steepest equity curve you can find. And so something like a return to drawdown measure could do that. Now there's others, there's lots of them out there. Sortino ratio is another one which is quite good. But those tend to give the best results. But you can then sort of take it a step further in that you can combine not only your what your desires are, but also what your limitations are. So, for example, you may not want to trade a system that makes any less than a certain percentage per trade. So you can build that also into the metric as well. And what that will do is that will exclude any systems or any incarnations of a particular system that don't meet those minimums, and that will allow you to basically filter out all those systems that you wouldn't like to trade anyway to begin with, and to only keep the good ones, and the best ones will then bubble to the top.
Okay, so we're just talking about system health. Can you use your optimization metrics when you start trading a system to monitor the health?
You can, yes, absolutely, yeah. I mean, you can use basically any metric you like, and so if you have an optimization metric that you already use, then you will know what the expectation is for that for that particular system, and so then you can use the short run calculation of that metric to compare against the long term, and to find out where it is in comparison. So you're establishing a range. So picking a number out the air, let's say the return to risk ratio is 1, then you may want to say, okay, well, I don't care about the upside. If the number gets bigger, then that's all good. But if there's a downside, say if it drops to 0.75 or 0.6, then I'm not going to trade it anymore. So yeah, absolutely, you could use that. Yeah.
Now, you also mentioned that people need to determine a system that suits their personality. How do you actually do that without trying a bunch first?
Well, I guess there's certain limitations on all of our lives. So that's the first thing to take into account. So, for example, you don't want to trade some foreign market live overnight if that's the time when you like to be asleep. So those kinds of things are going to establish which markets you're going to concentrate on. The next consideration is usually time frame. What time frame do you want to trade? Some people love staring at the screen for 6 hours a day and trading 1 minute bars or tick charts. Not for me. I must admit, I've tried it. I didn't like it. It was a lot of work for not much return, and certainly in my case anyway. But some people do very well at it. And other people, it depends. It really depends how much action you want, I guess, at the end of the day. Some people like systems that generate trades every day. Other people are quite happy with trading once a week or even once a month. So I think that's very much a personal choice, and that will direct you towards one or other end of the market. Again, if you're thinking of things like holding period as well, some people are quite comfortable holding stocks for a couple of minutes, couple of hours, couple of days even, and just turning them over very quickly. That will tend to do things like reduce market risk. So if you're a bit more risk averse, then you might like to have a shorter holding period. Of course, there's no free lunch in this business, of course, and a short holding period usually means you're gonna not get as much expectancy per trade as a result. If you're willing to take a little bit more risk in the market, hold for a little bit longer, usually you're going to be rewarded with a higher expectancy per trade. Same for win rate as well. Some people are comfortable trading systems that only win 20 or 30% of the time. Other people want systems that win 70, 80, 90% of the time. Again, you're going to pay for that in some way. If you want a system that trades 90% accuracy, usually it will be taking a very small bite of the market out each time. Then costs become an issue and so on. So it boils down to those 5 metrics. What expectancy per trade are you after? What sort of holding period? How much risk is in your appetite? What sort of win rate do you want? What's your probability look like? And then how much opportunity do you want? How much trade frequency do you want? And so, if you boil down those five metrics, if you like, to your own personal preferences, that will usually send you in one direction or other. So if you want to carry a bit more risk, you want to hold for a bit longer, you want a higher expectancy per trade, that's going to tend to move you towards more of the trend following types of systems. If you are looking for a high win rate and you're happy to take a lower expectancy and hold for a shorter period, then you're more likely to be moving towards the sort of swing type of systems and the mean revert type systems. So that will tend to drive you in one or other of those directions. Or you might be off the mind that you can happily trade both of those styles, and I think that's a good method as well. So I think you should try to match your own personality up with in other words, quantify your personality, if you like, in terms of the metrics, so that you can then match that to what particular style is going to be the best for you.
Okay, great. Thanks, Alan. That was a lot of good tips and advice there. Now, I'd just like to jump to anticipating trading signals, because I understand you've done some research into this. So perhaps you could explain what that is or what that means.
Yeah. Okay. Well, the main reason why you would want to anticipate a signal is if you want to trade a particular point in the day of the market. So what I've discovered through testing is that certainly mean revert type systems that are buying at extremes of price. So if we think about a long swing trading system, it might be looking for an extreme oversold condition, and then it's buying, hoping for the market to move back towards the mean. Now, those types of systems will tend to work better if you trade at the close of the market rather than the open. So what will often happen is the market will be sold hard into the close, and then the very next bar or the next trading day, it will tend to gap up. So there'll be an overnight gap in that sense. So by entering the market at the close, then you're able to capture that gap that you wouldn't otherwise get if you were trading at the open the following day after getting the signal. So in order to trade at the close, you need to be able to anticipate the signal, because if we think about most traditional indicators, most of them are generated off the closing price of the bar. So if we're trying to trade at the close, then obviously we're not going to know what that is until we get there. So in order to anticipate the signals, what you have to do is you have to use whatever method it is that you're using, and you have to basically reverse engineer that. So if we think, let's take a very basic example, a very basic and well-known example of the RSI, which is an oscillator, signals overbought, oversold conditions, and it moves between 0 and 100. So what we're trying to establish is, for a particular stock or instrument, if the RSI gets down to a certain level, then what does that mean in terms of price? And the way to do that is that you have to basically reverse engineer the RSI. Now, it's the actual algorithm or the formula to do that is widely available. It's public property, basically. It was published in Wells Wilder's book, so it's there to be to take. And so what you can do is you can feed the algorithm, the reverse engineer algorithm, the period and the level that you're looking for in the RSI, and it will spit back out the price. So then you can anticipate if the market reaches that particular price level by the close, then you're in. And so it will allow you to place your orders ahead of the market, so that you're not having to sit there, 5 seconds before the close with 10 stocks on your screen trying to determine what you're going to get in and out. So you can then place your orders even the night before. If the mechanics of your system are able to generate the anticipate the signals for the following day, then you could even generate your orders to place at the close the following day, the night before. And you can do that. I mean, there's what's called a conditional order, which is quite widely available. And what that is it's basically a market order, but it only executes once a certain conditions have been met. And in the case of this example, it would be when the time gets to a few moments before the close and where the price is below a certain level or above a certain level. So that's the reason for using them, and that's kind of the methodology that you have to take. Now, it will depend what you're using to generate for a mean reversion system. It's going to be something that determines the highs and the lows in a range of prices. So whatever that is that you're using to establish that, you're going to have to find out what the calculation or the formula is for that, and code it in reverse so that it gives you a price from an input of the level of the indicator itself.
Okay, that's interesting because I think some signals could be easy to anticipate, like moving averages could be quite easy to calculate, but some indicators can be really complicated, I guess, in their calculations. Are there specific types of signals that can't be anticipated?
Well, actually, you can code around most things. What you can do is you can, this might be getting a bit down into the detail of the code that you would actually use. But what you can do is you can just use a loop in your code that tests. From where the price is now all the way up or down, going 1 cent at a time to find out where you get the signal. So in the case of a moving average, find out, if the price tomorrow was this price, does the moving average do what you want it to do? If it was 1 cent higher, does it do it? If it's 2 cents higher, does it do it? And you can do that sort of iteratively to get the answer you want. So without having to reverse engineer the actual calculation for the indicator itself, you can just kind of simulate the price that it would be tomorrow and see what that does in terms of the where the indicator is at that point.
Oh, that's an interesting way of doing it. I'd get the computer to figure it out.
Absolutely, yeah.
Okay, well, thanks for sharing that with us, Alan. We can just start wrapping up now with some quick closing questions.
Sure.
The first one, what's the biggest lesson you've learned through trading?
The biggest lesson I've learned, I think for me, the biggest lesson that I've learned, or the biggest lesson that I've discovered, is that trading as an endeavor is a marathon and not a sprint. When we first come into trading as beginners, we want to take lots of leverage and we want to take lots of trades, but when we want to make lots of return, we make thousands and thousands and thousands every month or every week or whatever it happens to be. But what you find is that over time you're gonna have good times, you're gonna have bad times, you're gonna have good years, you're gonna have bad years. And to me, you really should have a sort of 5 to 10 year time horizon and not be too focused on what's happened this week or this month or even this year. It's just basically too short in terms of a period to make any real assessment about either a system or your own performance. So very much I think that we have to, it's easy when you look at a 15-year back test and say, oh yeah, well it goes from the bottom left-hand corner to the top right-hand corner. So yeah, I could trade that, no problem.
Yeah.
But what you're not seeing is if you zoom in, all those little ups and downs and bumps and flat spots that you're going to have to live through day by day by day. So I think, it's very easy to fall into what's called recency bias, where you just focus on the recent returns or the recent results. But I think, having that larger time horizon is going to give you a much better chance of success. So that's certainly what I try and focus on.
Yeah, cool. So another question, what is the best trading advice you've ever received?
The best trading advice, well, I think for me it was when somebody made me realize that but you should be happy with what you've got, but you should never stop striving for improvement. And it's very easy in the trading game, especially when you're new to it, to jump from one thing to another, or you hear somebody speak and you say, oh, maybe this guy's got the answer, or you see something in a book and you think, oh, maybe that's it, and you can sort of go around that so-called beginner's cycle a number of times. And even when you become proficient and competent and consistent at the game, and you have it's very easy to get sidetracked by new system ideas that you see or you hear about and think, oh, maybe that's better than what I've got. But I think if you've got something that works at the moment, focus on that first, because that's what's going to generate the returns that you need over the long term. And then also on the side, we should always be looking for new ideas, because like we said earlier, it never stops this. There's always new things coming out there. There's always new and better ways to do it. And to me, what we're trading right now is in effect our best candidate systems. But we should also then measure everything else that we come across against what we've got at the moment. If we find something better than what we've got, then good. Throw out what you've got and trade that. But if not, then can we bring it in to complement what you've got, or if not, then it needs to either go back on the back burner or thrown away completely. So compare everything that you come across with what you've got. But be happy with what you've got for now, and then just look for incremental improvements.
Yeah. What's your favorite way to find trading ideas?
Good question. Yeah, well, I've heard quantocracy mentioned on your show a few times, and that's certainly one that I look towards. There's lots of good stuff in there. It's it can be a little bit of a rabbit hole. Once you go in there, and you'll see lots and lots of ideas, and you'll think, oh, that looks good, and it's there's only so much time in the day, unfortunately, to have a look at all these things. So yeah, looking, the internet's a great resource now, but there's also a lot of crap out there. Let's be honest, But
Yep.
but the way that quantocracy goes about their filtering and their the websites that they support, I think is a great way to sort of cut out a lot of that noise and just focus on the good stuff. So that's one thing.
Yep.
Trading books, I haven't really got a lot of time for trading books themselves. Most of the ideas in them are not worth the paper they're written on. I think one of the best methods is to talk to other people. To talk to other traders, people that are doing it already, share ideas. I mean, I think the thing that we've got to remember as independent traders is that our competition isn't each other. Our competition is out there. It's the professional fund managers. It's the big banks. It's the people trading at size that are eroding edge from the markets all the time. So I don't think anybody should be too secretive about what they're doing. I think we should all try and share our ideas as much as possible. I'm not saying give away your secret sauce to everybody, but I'm saying share what your strategy is on a high level, and that might sort of trigger someone else to be able to do something like that themselves. So I like talking to a lot of different traders, finding out what they're doing and sharing ideas. And I've got a sort of small network of people that I do that with as well. As in terms of advice, if you're just solo on your own, focused on trying to do it for yourself, I'd say try your best to get involved with a trading group if you can, or looking for things like technical analyst associations or even meetups and so on. Those are great ways to sort of get out and meet other people and listen to what they're doing as well. So yeah.
Thanks, Alan. And what's the best way for listeners to get in touch with you?
Sure. Well, they can contact me by email. My email is Alan, which is ALAN @helixtrader.com. Or they can go to my website, which is allthews.helixtrader.com. And I'd be happy to hear from anybody and open a discussion.
Excellent. So thanks so much for chatting with us today, Alan. Is there anything else that you'd like to mention before we wrap up?
I'd just like to wish everybody the best of luck. I know there's a lot of guys who are already converted to the systematic cause, if you like, that listen to you already. So, I just wish them well in the game, and let's all strive for the best success that we can get.
Fantastic. Thanks, Alan. So, thanks a lot for spending time with us today and sharing some insights and ideas about trading that you had. So thanks again, and I wish you all the best for the future.
That's my pleasure. Thanks for the opportunity, Andrew.
Cheers, Alan.
Cheers.
I hope you found the chat with Alan interesting this week. He shared some really nice tips with us. Here are two of my favourites. The first is the application of Monte Carlo analysis for dynamic position sizing. We can do this with live trading by feeding a rolling window of the most recent trades into our Monte Carlo engine and using the results to determine the position size for the next trade. The advantage of that is a reduction in position size when the system is in drawdown, but also increased position size when the system is going through a profitable run. The second takeaway was the applications to monitoring system health. You can monitor system health by comparing the short run statistics to the long run statistics using Again, a rolling window of the most recent trades and comparing the results to the longer-term backtest results. Establish a limit where you'll stop taking trades if the performance degrades by a specific measurement, whether it be drawdown level, win percentage, consecutive losses, whatever applies to your style of trading. When that point arrives, stop taking new trades, but continue to monitor how the system would have performed if you had taken those trades. And you're waiting to see if the system comes back into sync with the market and pops up above your limit point, in which case you can start trading the system again. If you have any questions or comments for Alan, or just want to get more information about this episode, head over to the show notes at bettersystemtrader.com/29. Alan will be answering all of your questions there, plus we have links to additional content if you'd like to know more about Alan and his work. And for those that listen to the podcast through iTunes, can I please ask you to share your support by leaving a rating for the show? It would really help to spread the word and reach even more listeners. Anyway, that's it for this episode. Thanks for listening to Better System Trader, and I'll catch you next week for episode 30. I have something a little different to share with you, so I'm really excited to do that. Catch you then.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.